Edward is 66. He retired last year, not after a crisis, not because of poor planning, and not because he was forced out of work. He retired because, on paper, everything looked ready. His home was paid off. He had no major debt. His children were financially independent, and his portfolio had reached $1 million. So he used one of the most familiar rules in retirement planning: withdraw 4%. That meant $40,000 per year from the portfolio, then adjust that amount gradually for inflation over time. Simple, widely discussed, easy to model, and for many retirees, reassuring. But then something happened that changes the math more than most people expect. In Edward's first year of retirement, the market dropped 20%. His portfolio did not stay at $1 million. It fell to $800,000, and yet his spending plan had been built around a number that no longer existed. That is where this gets more serious, because the withdrawal amount did not fall by 20% just because the market did. Edward still needed income. His utilities did not decline. His groceries did not decline. His insurance premiums did not decline. His property taxes did not decline. And his healthcare costs certainly did not ask whether the market was having a bad year. So now the question changes. It is no longer, can 4% work over time? The better question is this: what happens when a retirement plan built on 4% collides with a major loss at the exact wrong moment? Because that is where many retirement projections become misleading. They often rely on averages. But retirement does not happen in averages. It happens in sequence. And sequence matters most when withdrawals begin. A bad market before retirement is uncomfortable. A bad market during accumulation can often be recovered from with continued contributions. But a bad market in the first years of retirement is different. Now money is not only falling, it is also being pulled out. So in this video, we are going to model one central question very carefully. Did the 4% rule fail after a 20% drop, or did the real failure come from using a fixed withdrawal plan in a fragile early retirement environment? We will walk through the first year math slowly. Then we will compare two paths. One where retirement begins under stable market conditions, and one where retirement begins with an immediate 20% decline. And most importantly, we will answer the question this channel always asks. What did this decision change over 10, 15, and 25 years? Let's start with the base math, slowly, because this is where the entire retirement decision begins to shift. Edward retires with $1 million. His chosen withdrawal rate is 4%. So in year one, he plans to take $40,000 from the portfolio. That sounds clean, and in one sense it is. 4% of 1 million is 40,000. No complication there. But the mistake many people make is assuming that once a withdrawal number is set, the risk stays constant. It does not. The dollar withdrawal may stay the same. The percentage changes whenever portfolio changes. That is the first distortion, and it shows up immediately when markets fall early in retirement. So let's build two versions of Edward's first year, a baseline year and a stress year. In the baseline year, assume the market behaves reasonably well, not spectacularly, not euphorically, just well enough to support a normal retirement projection. Let's say the portfolio earns a 6% return before withdrawals. On $1 million, that is $60,000 of growth. So the portfolio rises from $1 million to $1,060,000. Then Edward takes his $40,000 withdrawal. That leaves him with $1,020,000 at the end of the year. So in the baseline path, Edward withdrew income and still ended the year above where he started. That is what many retirement projections quietly assume in the early years. Not exact numbers, but a general idea that a portfolio has time and market cooperation on its side. Now let's look at the stress path. Same retiree, same starting balance, same withdrawal plan. But this time, the market drops 20% in year one. A 20% decline on $1 million reduces a portfolio by $200,000. Now the balance is $800,000. And Edward still needs his $40,000. So after that withdrawal, the portfolio is no longer $800,000. It falls to $760,000. Compare the 2-year one endings. In the baseline path, he finishes with $1,020,000. In the stress path, he finishes with $760,000. That is a gap of $260,000 after just 1 year. And that gap matters more than it first appears, because the problem is not only the loss. The problem is what the loss does to every future withdrawal, every recovery year, and every later expense that must now be funded by a smaller base. Now look at the withdrawal rate itself. At the start, $40,000 was 4% of $1 million. That felt disciplined, measured, within the range many retirees have heard is sustainable. But after the market decline, before any spending adjustment, that same $40,000 is no longer 4% of the portfolio. On an $800,000 balance, it is 5%. And if the withdrawal happens after the decline, leaving $760,000, then the retirement pressure is even more obvious, because now the portfolio has to recover from a lower level while still supporting the same lifestyle. That is why early retirement losses are different from losses during working years. During accumulation, a lower market can even help if you're still buying. During retirement, a lower market forces you to sell assets at depressed values to fund spending. So the sequence of returns problem is not abstract. It is mechanical. It is arithmetic. And it appears the moment withdrawals begin during a downturn. Now, let's add one more realistic layer. Edward is not likely to keep his spending flat forever. Most retirees following a classic 4% framework assume they will increase withdrawals with inflation over time. So $40,000 in year one does not remain $40,000 in year 2 or year 3. Let's use a modest 3% annual inflation adjustment. That means in year 2, Edward's plan withdrawal rises from $40,000 to $41,200. In a stable path, that increase may be manageable. In a damaged path, that increase is now hitting a portfolio that is already under stress. So the pressure is no longer just market risk. It becomes market risk plus inflation plus withdrawal rigidity. This is why a fixed rule can become fragile. Not because the original percentage was reckless, but because reality changes faster than the plan does. And here is the key point for the rest of this video. Edward's retirement did not become dangerous because he was irresponsible. It became vulnerable because the order of returns turned against him early, and his spending rule did not yet know how to respond. So from here, we need to stop looking only at year one. The real question is what this first-year distortion changes over the next decade and beyond. Because if 2 retirements start with the same $1 million, but one suffers a 20% decline in the opening year, what does that change by year 10? Now we extend the model forward. Because the first-year loss is only the opening distortion. The real issue is what that distortion does over the next 10 years. Let's keep the assumptions clean and consistent. In both scenarios, Edward starts retirement with $1 million. In both scenarios, he begins with a $40,000 withdrawal. In both scenarios, that withdrawal rises by 3% per year to reflect inflation. The only difference is the opening sequence. In the baseline path, the first year is stable. The portfolio earns a modest positive return. In the stress path, the first year delivers a 20% decline before withdrawals continue. After that, we assume markets normalize and produce the same long-term average return path in both cases. That matters because now the divergence is not being caused by different long-term market assumptions. It is being caused by timing. So let's map the withdrawals first. With a 3% annual inflation adjustment, Edward's portfolio distributions look roughly like this. Year 1, $40,000. Year 2, $41,200. Year 3, $42,436. Year 4, $43,709. Year 5, $45,000 and change. By year 10, the annual withdrawal is no longer $40,000. It is roughly $52,000. That is normal retirement math. The spending amount rises because costs rise. Even if Edward is not living extravagantly, inflation keeps moving. Insurance moves, food moves, utilities move, maintenance moves, and healthcare often moves faster than all of them. Now let's compare the portfolio paths. Under the baseline scenario, where the first year remains stable and long-term returns cooperate reasonably well, Edward's portfolio at year 10 is still holding around $940,000 to $1 million, depending on return timing within the decade. For this model, let's use a central estimate of about $970,000 remaining at the end of year 10. Notice what that means. Edward has already taken 10 years of income from the portfolio. His annual withdrawal has risen from $40,000 to roughly $52,000, and yet the account is still close to where it began. That is what makes the 4% rule look durable in a favorable sequence. The retiree is drawing income, inflation adjustments are happening, and the portfolio still appears resilient. Now look at the stress scenario. Same retiree, same spending, same inflation adjustments, same long-term return assumption after the first year decline. But because the portfolio began from a damaged base and continued supporting withdrawals while recovering, the account at year 10 is materially lower. For this model, it lands closer to $680,000. That is a difference of about $290,000 by year 10. And that is the part many retirement plans do not make visible enough. A bad opening year does not just create a temporary paper loss. It changes the level from which recovery must happen, while real money is still leaving the account every year. So let's translate the numbers into a more practical retirement question. In the baseline scenario, Edward enters year 11 with a portfolio still close to $1 million. He has room. He has flexibility. A bad year would still hurt, but it would not immediately threaten the structure of the plan. In the stress scenario, Edward enters year 11 with around $680,000. His withdrawal need is now around $52,000 per year. So before even discussing taxes, Medicare premiums, or medical surprises, the portfolio is already being asked to fund a noticeably larger share of itself. $52,000 on a $680,000 balance is not 4% anymore. It is closer to 7.5%. That does not automatically mean failure in the next year, but it does mean the retirement plan is no longer operating in the safe-looking structure it began with. And that distinction matters, because retirees do not experience risk only when a portfolio hits zero. They experience risk when flexibility starts disappearing. A 10-year retirement with a portfolio near $1 million feels different from a 10-year retirement with a portfolio under $700,000, even if both households are technically still solvent. One household can absorb surprises. The other has to think harder before every adjustment. A roof replacement becomes a bigger decision. Helping an adult child becomes a bigger decision. Replacing a car becomes a bigger decision. Travel becomes a bigger decision. Even delaying home maintenance starts to feel tempting, which often creates bigger expenses later. This is the first major divergence point in the video. By year 10, the issue is no longer whether the market eventually recovered. The issue is whether the retiree still has enough capital strength to keep living with confidence. And this is where retirement planning becomes more than average return charts. Because two retirees can experience the same market over 10 years, yet end the decade in very different conditions depending on when the damage happened. That is sequence risk in practical form, not theoretical, not academic. Just one bad opening year, changing the next decade of decisions. So by year 10, Edward's early market drop has not merely reduced the account value, it has changed the structure of retirement itself. It has reduced cushion, reduced optionality, and increased sensitivity to every future cost. But the story does not stop there, because retirement is not a 10-year problem. For many households, it is a 25-year problem, and the most important damage often becomes clearer in the middle years, when inflation has compounded and the portfolio has had less capital left to work with. By year 10, the divergence is already visible, but year 15 is where the retirement plan starts revealing whether it was truly durable or simply stable for a while. Because the middle years of retirement are where several pressures begin to overlap. Withdrawals are higher than they were at the start. Inflation has had more time to compound. The retiree has fewer working years behind them to offset mistakes. And the portfolio has had 15 years of carrying both market variability and ongoing spending. So let's extend Edward's model. We keep the same two paths. The baseline path began with a stable first year and reasonable long-term returns. The stress path began with a 20% decline in the opening year, followed by the same normalized return assumption afterward. Now look at the withdrawal side first. Edward started at $40,000 per year. That amount rises by 3% annually. By year 15, his planned annual withdrawal is no longer anywhere near $40,000. It is now roughly $62,000 per year. That is not because he became extravagant. It is because retirement spending must keep pace with reality. The cost of maintaining the same standard of living drifts upward year after year, and even a modest inflation rate becomes powerful when applied over 15 years. Now let's compare portfolio balances. In the baseline path, Edward's retirement still looks structurally stable. After 15 years of withdrawals, with inflation adjustments included, the portfolio remains around $850,000 in this model. That is lower than the starting balance, of course, but it is still substantial. It still offers flexibility. It still leaves room for a difficult year without immediately changing the entire retirement plan. Now compare that with the stress path, because the opening loss reduced the recovery base, and every later withdrawal continued to compound against a smaller portfolio. Edward's balance by year 15 is now closer to $450,000. That is a gap of roughly $400,000 between the two retirements. And this is where many viewers begin to see why the distortion accelerates rather than fades. At first glance, some people assume that once markets recover, the damage should mostly disappear. But that is not how retirement withdrawals work. If a portfolio falls early and distributions continue, fewer dollars remain invested for the recovery. That means later gains are being earned on a smaller base. And when inflation-adjusted withdrawals keep rising, the drag becomes heavier just as the capital base is weaker. This is one of the most important points in retirement modeling. A portfolio does not need to collapse immediately for a plan to become fragile. It only needs to lose enough resilience that future decisions become narrower and harder. Look at the withdrawal rate pressure now. In year 15, Edward's annual spending need is around $62,000. On an $850,000 baseline portfolio, that is still manageable. Uncomfortable in a bad market, yes, but not structurally alarming on its own. On a $450,000 stress portfolio, however, that same $62,000 now represents a very different burden. It is nearly 14% of the remaining account. And that is before layering in taxes, before unexpected healthcare costs, before major home repairs, before helping family, before long-term care exposure, before higher Medicare premiums. So by year 15, the difference is no longer just a portfolio gap on paper. It becomes a difference in retirement posture. In the baseline path, Edward is still managing a portfolio. In the stress path, Edward is increasingly defending one. That shift matters psychologically and financially. because a retiree who feels forced into defense starts behaving differently. They delay spending. They second-guess normal purchases. They hesitate over travel. They postpone maintenance. They become more sensitive to every headline, every market swing, and every conversation about inflation. And in some cases, they begin making decisions that protect the account in the short term, while quietly reducing quality of life in the long term. This is also the stage where flexibility becomes more valuable than rules. A retiree who insists on maintaining every inflation increase regardless of market conditions may preserve consistency, but consistency is not always the same as stability. Because by the midpoint of retirement, the danger is not only running out of money completely, the danger is spending the later years of retirement with too little room to respond. And that is why the year 15 view matters so much. Year 10 shows divergence. Year 15 shows whether the original strategy created endurance or merely delayed vulnerability. So let's step back and ask a better question. If two retirees started with the same $1 million, and one of them is sitting at $850,000 in year 15, while the other is closer to $450,000, was the difference really caused by average returns? Not in this model. The average return assumption after year one was the same. The difference came from sequence, withdrawals, and the compounding effect of beginning from a damaged base. This is why a retirement plan should never be judged only by whether it works in the median path. It must also be judged by how it behaves when the first few years go wrong. And that leads directly into the next stage, because once we reach year 20 and year 25, the question becomes even more important. Did the early 20% drop create a difficult period that eventually normalized, or did it permanently alter the retiree's long-term capacity to stay independent, flexible, and financially calm? Now we move into the years that matter most in retirement planning. Not just the first decade, not just the difficult middle years, but the period where a retirement plan proves whether it was built for comfort or built for durability. Because a retirement decision is not finished when the first withdrawal is taken. It is tested over 20 years, sometimes 25, sometimes longer. So let's carry Edwards' two paths forward. Same person, same initial portfolio, same starting withdrawal, same inflation adjustments, same normalized return assumption after the opening year. The difference remains the same one we started with. A stable beginning versus a 20% decline at the exact moment retirement started. By year 20, the baseline path is still functioning. The portfolio has continued supporting income for 2 full decades. Withdrawals have risen with inflation, and yet the account still holds a meaningful reserve. In this model, Edwards' baseline portfolio remains around $620,000 at year 20. That matters, because it means the plan is still alive. It still contains optionality. It still provides a buffer against late retirement uncertainty. Now compare that with the stress path. By year 20, after the damaged opening sequence and the continuing effect of withdrawals from a smaller base, Edwards' portfolio is down to roughly $180,000. That is not a minor gap anymore. That is a structural separation between two retirements that began with the exact same $1 million. And by this stage, the withdrawal pressure is no longer subtle. Edwards' annual spending need, after years of 3% inflation adjustments, is now around $72,000 per year. $72,000 on a $620,000 baseline portfolio is demanding, but it still exists inside a framework that can be managed with careful adjustments. $72,000 on $180,000 is no longer a sustainable portfolio withdrawal strategy. It is a warning sign that the original structure has been exhausted. This is the point where retirement planning stops being about theory, because the stress path retiree is no longer asking, how much flexibility do I have? Now the question becomes, what must change immediately? By year 25, the divergence becomes even clearer. In the baseline path, Edward may still have around $350,000 to $400,000 remaining, depending on exact return order and spending behavior in the later years. For this model, let's use $380,000. In the stress path, however, the portfolio is either very near depletion or already functionally exhausted. For modeling clarity, we can treat the year 25 stress balance as near zero, with the retiree now heavily dependent on guaranteed income sources, spending reductions, or both. And that is the answer to the channel's central question. What did this decision change over 10, 15, and 25 years? It changed far more than the account balance. It changed the retiree's margin for error. It changed how much inflation could be absorbed. It changed whether healthcare surprises could be handled calmly. It changed whether housing decisions remained optional or became forced. It changed whether family support, travel, charitable giving, and everyday flexibility remained possible late in life. That is why the phrase, the 4% rule failed, is only partly true, because in many cases, the real issue is not that the initial withdrawal percentage was irrational. The issue is that a fixed withdrawal structure was asked to survive a sequence it was never stress tested for properly. A 20% market drop does not automatically destroy retirement, but a 20% market drop in the opening phase of retirement can permanently alter what the next 25 years look like. And that distinction matters, because if the problem is sequence vulnerability rather than a universal rule failure, then the solution is also different. The solution is not panic. It is better modeling, better guardrails, and better decisions before the first distribution begins. At this point, Edward's story has already shown us the main structural risk, but real retirement does not happen with portfolio math alone. There are other variables that can magnify or soften the damage. And the first one we need to add is a variable that many retirement models still understate: healthcare inflation. Up to this point, we have treated Edward's withdrawals as if they rise with general inflation. That is useful for clean modeling. But real retirement spending is not evenly distributed, and one of the biggest distortions appears in healthcare. Because healthcare costs do not always move in line with the broader inflation rate. In many retirement years, they rise faster, sometimes much faster. So now we need to separate two things: general lifestyle inflation and healthcare inflation. In the earlier model, we assumed Edward's portfolio withdrawals rise by 3% per year. That is a fair approximation for broad inflation over time. But healthcare expenses often behave differently. Premiums, deductibles, prescription costs, dental work, hearing support, vision care, specialist visits, and out-of-pocket procedures can rise at a rate that exceeds general consumer inflation. So, let's build a simple layer into Edward's retirement. Assume that of his original $40,000 withdrawal, about $10,000 represents healthcare-related spending in some form. Not necessarily in year one alone as a single bill, but as part of the ongoing retirement budget when premiums, supplemental coverage, prescriptions, co-pays, and recurring care are considered. Now, let's say the non-healthcare portion of his spending rises by 3% annually, but the healthcare portion rises by 5.5% annually. That may not sound dramatic at first, but over 15 to 25 years, the difference becomes meaningful. At a 3% inflation rate, $10,000 grows to roughly $18,000 over 20 years. At 5.5%, that same $10,000 grows to roughly $29,000 over 20 years. That is an $11,000 annual difference in just one spending category. And that matters because healthcare is not usually optional spending. A retiree can trim travel, delay a car purchase, cut restaurant spending, pause a home project. But many healthcare expenses arrive with much less flexibility. So now reframe Edward's year 20 problem. In the baseline path, his portfolio is still around $620,000. That does not make higher healthcare costs pleasant, but it does mean there is still capital available to absorb them. In the stress path, His portfolio is around $180,000. Now, a fast-rising healthcare category is not just another budget line. It becomes a destabilizer. Because when a portfolio is already weakened, non-negotiable cost growth becomes more dangerous than discretionary inflation. The retiree is no longer deciding whether they want to spend more. They are deciding whether they can. This is where retirement math becomes more realistic. A general inflation assumption alone can understate late retirement pressure, especially when essential categories rise faster than the headline rate. And healthcare is not the only issue. Higher medical spending can interact with Medicare premiums, taxable income planning, and even the timing of portfolio withdrawals. A larger distribution from a traditional IRA can push income upward. Higher income can increase Medicare-related costs, and those costs then feed back into withdrawal need. So by this stage, Edward's stress scenario is no longer just about market decline from years ago. It is about a retirement structure that has less room to absorb uneven inflation in the categories that matter most. That is the real lesson here. A weakened portfolio does not suffer only from lower balances. It suffers from reduced ability to absorb asymmetrical costs, and healthcare is one of the clearest examples. In other words, the same 20% opening drop has now changed something else over 20 years. Not just investment flexibility, but medical resilience. If Edward reaches his late 70s or early 80s with a damaged portfolio, then rising healthcare costs do not arrive as an inconvenience. They arrive as a structural test of whether the original retirement decision left enough margin. This is why retirement planning should never assume all inflation is equal, because if the fastest growing expenses are the least flexible ones, then the retiree with the weaker portfolio does not merely face higher costs. They face fewer acceptable responses. And that brings us to the next major variable. Because when a portfolio is under pressure, one of the most important decisions becomes the timing of guaranteed income. In other words, when should Edward claim Social Security? Now we add another decision that can either relieve pressure or unintentionally increase it. Social Security timing. Because once a portfolio has been weakened early, guaranteed income becomes more valuable, not emotionally, structurally. A larger Social Security benefit can reduce portfolio withdrawals later in retirement, but delaying benefits also means a portfolio has to carry more of the burden in the years before those checks begin. So let's model two paths for Edward. Assume Edward retired at 66. His full retirement age benefit is about $2,800 per month if claimed near full retirement age. If he claims immediately, that gives him roughly $33,600 per year in Social Security income. If instead he delays until age 70, his benefit rises by roughly 8% per year plus any cost of living adjustments along the way. That could lift his annual benefit closer to $42,000 per year. That later benefit is clearly stronger. On paper, delaying looks attractive. Higher guaranteed income, more longevity protection, less pressure on the portfolio in later years. But now bring back the sequence of returns problem. If Edward's portfolio fell 20% in his first retirement year, and he still delays Social Security until 70, then for 4 years the portfolio must keep covering most of his income needs with no large guaranteed benefit yet in place. That means the damaged portfolio is being asked to do even more during the years when it is most fragile. Let's make that concrete. Suppose Edward's target spending need is $60,000 gross in early retirement once taxes, housing, healthcare, food, and other normal categories are included. If he claims Social Security sooner and receives about $33,600 annually, then the portfolio may only need to cover roughly $26,000 to $30,000 of the remaining gap, depending on taxes and other income sources. If he delays benefits, however, then the portfolio may need to fund almost the entire gap for several years. That could mean drawing $50,000 to $60,000 per year from a portfolio that has already been hit hard. So this is where the decision becomes more nuanced. In the baseline scenario, where portfolio remained relatively strong, delaying Social Security may still be a very good decision. A strong portfolio can bridge the early years more comfortably, and the reward is a larger guaranteed benefit later. In the stress scenario, however, the same delay strategy may increase short-term withdrawal pressure exactly when a retirement plan can least afford it. So the answer is not simply delay Social Security whenever possible, and it is not claim as early as possible after market decline. The answer is that Social Security timing should be modeled in context of portfolio damage, withdrawal pressure, longevity expectations, and tax structure. Here is the practical trade-off. Claiming earlier may reduce withdrawals from a damaged portfolio and help preserve capital in the fragile years. But the cost is a lower guaranteed monthly income for the rest of retirement. Delaying may maximize long-term guaranteed income, which can be very powerful in later life. But the cost is heavier dependence on the portfolio during the bridge years. And if those bridge years happen right after a major market decline, the math can tilt in a different direction than generic advice suggests. This is why Social Security timing is not a standalone optimization problem. It is part of the broader retirement structure. It must be tested against portfolio volatility, health expectations, spending flexibility, and the retiree's tolerance for pressure in the first decade. So what did the 20% drop change here? It changed the quality of Edward's choices. In the baseline path, delaying Social Security may feel like an intelligent optimization. In the stress path, delaying can start to feel like a gamble unless other safeguards are already in place. That is an important distinction, because a strong retirement plan does not only give you more money, it gives you better options. And when the options get worse, even otherwise sound strategies become harder to execute. So now we have seen 3 layers of strain: the opening market loss, healthcare inflation, and the Social Security timing trade-off. The next question is the one many retirement plans ignore until it's too late. What should Edward actually do with withdrawals once the damage has already happened? Because if the real problem is not only the 4% rule, but the rigidity of following it without adjustment, then the next layer we need is a set of withdrawal guardrails. This is the point where the real lesson begins to sharpen. Because if Edward's retirement was damaged by a 20% decline in the opening year, then the next question is no longer whether the original rules sounded reasonable. The next question is whether the plan had any built-in response once reality changed. And for many retirees, that is where the actual weakness appears, not in the first withdrawal rate itself, but in the lack of guardrails around it. A fixed rule can be useful as a starting framework, but retirement is rarely stable enough to be run on autopilot for 25 years. Markets change, inflation changes, healthcare changes, tax rules change, spending priorities change, and sometimes confidence changes faster than any spreadsheet expected. So let's separate 2 retirement systems. The first is a rigid system. Edward starts at $40,000, raises that amount by inflation each year, and continues regardless of market stress unless the account becomes obviously threatened. The second is a guardrail system. Edward still begins with 4% framework, but he predefines how withdrawals will adjust if the portfolio falls beyond certain thresholds. That second approach matters, because once the market drops early, the retiree does not need more opinions. He needs a decision framework. So what might those guardrails look like? One simple example is this. If the portfolio falls by more than 10% from its retirement start value, skip the inflation raise for the next year. That means instead of moving from $40,000 to $41,200 in year 2, Edward holds withdrawals flat at $40,000 until the portfolio stabilizes. That may not sound dramatic, but small spending restraints early can preserve meaningful capital later, especially when applied before the damage compounds further. A second guardrail could be a percentage reduction in discretionary spending after deeper declines. For example, If the portfolio falls by 20% or more, Edward reduces total withdrawals by 5 to 10% for a defined period, while protecting essential expenses first. That distinction is important. Guardrails should not begin by cutting medication, insurance, or core housing costs. They should begin by separating essential spending from flexible spending before retirement even starts. So Edward's budget might be divided into two layers. Essential spending: housing, food, utilities, insurance, healthcare, taxes, transportation, and core household costs. Flexible spending: travel, gifting, upgrades, non-essential subscriptions, discretionary purchases, and elective projects. Once that separation exists, a down-in response becomes much more practical. The retiree is not forced to improvise under pressure. The plan already knows what gets protected first and what gets reduced first. Another guardrail is a cash reserve. If Edward entered retirement with 1 to 2 years of planned withdrawals in cash or short-term reserves, then the first market decline would not automatically force him to sell as many depressed assets immediately. That does not eliminate the market loss, but it can reduce the sequence damage by giving the portfolio more time to recover before distributions resume from volatile holdings. A fourth guardrail is dynamic review rather than blind annual increases. Instead of assuming every year deserves the next inflation adjustment, the retiree asks a better question. Is the portfolio in a condition to support this raise without increasing long-term fragility? Now, let's compare how this changes Edward's path. In the rigid version, the year 1 drop pushes the portfolio lower, and year 2 spending still rises automatically. Over time, every increase compounds against a portfolio that has already been weakened. In the guardrail version, Edward responds early. He skips 1 or 2 inflation raises, reduces discretionary spending temporarily, uses reserve cash if available, and slows the pace at which money leaves the account during the most fragile years. Will that restore the baseline scenario completely? No, the early damage still matters, but it can materially improve the later outcome by reducing how much permanent capital is lost during recovery years. And that leads to a critical conclusion. The 4% rule is not always dangerous because it starts too high. Sometimes it becomes dangerous because the retiree treats it as permanent, regardless of what the portfolio is signaling. In other words, the failure is often not the initial number. It is the absence of a response system. This is where many retirement plans look fine in calm markets and then become fragile in volatile ones, because the plan contains an entry rule, but not an adjustment rule. And that is not a small oversight. Over 20 to 25 years, the ability to adjust withdrawals intelligently may matter as much as the original withdrawal percentage itself. So now we have enough structure to pause and ask the viewer the most useful question in the middle of this model. Not a dramatic question, a planning question. At this stage, the numbers have already made the main issue clear. A 20% decline in the early years of retirement does not just reduce a portfolio, it changes the quality of decisions available later. So here is the mid-video question that matters most. If your portfolio fell 20% in the first 2 years of retirement, would your current plan tell you exactly what to cut, what to delay, and which income source to use next? Not in theory, in writing, with numbers, with thresholds, with a sequence you already trust before the pressure begins. Because that is where many retirement plans quietly break down, not at the point of savings, not at the point of retirement, but at the point where the retiree must make difficult adjustments without a predefined system. And that leads into the psychological layer of retirement risk. This part is often underestimated because it does not appear neatly on a spreadsheet, but it still changes outcomes. A retiree does not need to be out of money to feel financially exposed. They only need to feel that the margin for error is shrinking faster than expected. That feeling changes behavior, sometimes wisely, sometimes destructively. In Edward's baseline path, The portfolio remains strong enough for the first decade, and into the middle years that normal life still feels manageable. He may still review spending carefully. He may still dislike down markets, but the structure of retirement remains intact. In the stress path, however, the same retiree begins to experience a different kind of pressure, not because the portfolio is already gone, but because confidence is no longer supported by visible cushion. And once confidence changes, spending behavior changes too. Travel gets postponed, home improvements get delayed, routine purchases get second-guessed, family support becomes more complicated, a medical decision may feel heavier than it should. Even ordinary market news can begin to feel personal. This is one of the most important realities of retirement planning. The goal is not merely to avoid depletion. The goal is to preserve enough structural strength that the retiree can live without constant defensive thinking. Because when every decision starts feeling like a trade-off against future survival, retirement stops feeling like independence and starts feeling like preservation. That shift is subtle at first, then cumulative, then lifestyle defining. A portfolio under pressure can still produce income, but it may stop producing confidence. And confidence matters more than many models admit. It affects whether someone visits family more often, whether they move, whether they stay in a home that no longer fits their needs, whether they seek care early or wait, whether they continue giving generously or begin protecting every dollar. So when we ask what this decision changed over 20 to 25 years, the answer includes more than ending balances. It includes a retiree's lived experience inside the plan. That is why sequence risk is so powerful. It does not only change the math, it changes a retiree's posture toward life, often years before an actual financial crisis appears. And that is also why better planning is not just about maximizing returns. It is about reducing the chance that the retiree spends later years constantly negotiating with uncertainty. So now the question becomes practical. What decisions actually make a plan more durable before retirement begins and more stable after volatility arrives? So let's close this model the right way, not with slogans, not with panic, but with decisions. Because the lesson from Edward's retirement is not that every 4% withdrawal plan is automatically broken. The lesson is that a retirement strategy must be designed to survive a bad opening sequence, not just a comfortable average. So here are the decision rules that matter most. First, before retiring, model a bad first 2 years, not just an average 20-year return. Do not ask only, what if my portfolio earns 6 or 7% over time? Also ask, what if I retire and the market falls 15 to 20% immediately? Then test what happens to withdrawals, taxes, healthcare spending, and guaranteed income decisions under that stress. If the plan only works when markets cooperate early, it is not yet a complete retirement plan. Second, during volatile years, do not keep spending on autopilot. A fixed withdrawal framework may be a useful starting point, but a retirement plan needs adjustment rules. That means knowing in advance when to skip inflation raises, when to reduce discretionary spending, and when to protect cash rather than sell more depressed assets. Third, separate essential spending from flexible spending before retirement begins. This is one of the simplest but most powerful planning moves. If markets fall early, the retiree should not be deciding from scratch what can be reduced. That work should already be done. Housing, food, insurance, transportation, taxes, and core healthcare belong in one category. Travel, gifting, upgrades, and elective spending belong in another. That separation turns stress into a decision process instead of a guessing exercise. Fourth, evaluate Social Security timing only after testing portfolio stress. Delaying benefits can be a strong long-term move, but it is not automatically the right move if the portfolio has already taken early damage and must carry too much weight during the bridge years. The better question is not, how do I maximize Social Security in isolation? The better question is, which claiming strategy improves the full retirement structure after market risk? Spending needs, taxes, and longevity are modeled together. Fifth, build guardrails before the first retirement withdrawal is taken. Do not wait for fear to create the rules. Create the rules while the mind is still calm. Define what triggers a spending freeze. Define what triggers a temporary reduction. Define what reserve assets are used first. Define how often the plan gets reviewed, because retirement is much easier to manage when the response system already exists. Now step back and return to the central question of this episode. Did the 4% rule fail after a 20% drop? In one sense, yes, if it was followed rigidly, without adjustment, in a fragile early retirement sequence, the outcome can deteriorate badly over time. But in a deeper sense, the real failure was not the number alone. It was the assumption that one withdrawal formula could remain unchanged even after the structure supporting it had changed. And that is the real retirement lesson. A plan is not strong because it works in a calm market. A plan is strong because it still holds together when the first years go wrong. Edwards' one decision did not just change year 1. It changed year 10. It changed year 15. And by year 25, it changed whether retirement still had flexibility or only constraints. That is what this channel always comes back to. What did the decision change over 10 to 25 years? In this case, it changed portfolio survival, spending freedom, healthcare resilience, Social Security strategy, and the retiree's ability to live with confidence rather than constant defense. So here's a question to think about as you review your own plan. If a major market decline hit in your first year retirement, would you rather protect lifetime guaranteed income first or preserve portfolio growth first? Because the answer to that question says a great deal about how your retirement is actually structured.